The final 12 hours before the 1929 crash were anything but normal. They were the most deceptive hours in financial history. The world still believed the party would never end, but the foundations were already collapsing beneath them. People woke up expecting another profitable day on Wall Street, but they had no idea what was coming. They were walking toward the most destructive market collapse ever seen. Fortunes would vanish in hours. Banks would crumble, life savings would disappear, and the world would enter a decade of suffering. Yet almost no one saw the danger, even with every warning sign right in front of them. To understand why those last 12 hours mattered, we need to understand why they matter even more today. Because the patterns that caused the 1929 collapse are repeating themselves right now. But to see how it all began, we must rewind, back to late October 1929. The Roaring Twenties were glowing with wealth and optimism. New York pulsed with jazz, success, and endless confidence. The stock market had surged for 8 straight years. Stocks had risen more than sixfold since 1921. Everyone wanted in. Everyone believed the future could only get better. Investing became the national obsession. Taxi drivers bragged about stock picks. Factory workers borrowed money to buy shares. Families discussed investments at dinner. It was the age of unstoppable optimism. The belief that markets only go up. Wall Street fueled the frenzy. Brokerages pushed dangerous margin loans. People bought $100 of stock with just $10 of their own money. Credit was handed out like candy. Newspapers celebrated overnight millionaires. Radio ads promised a guaranteed future. The mood was electric, confident, unstoppable. But beneath that glitter, something was breaking. By mid-1929, production is slowing, consumer demand is weakening. Factories are laying off workers, exports are falling. Major companies report disappointing profits. But the stock market keeps climbing anyway, because people believe it must go up. Speculation, not fundamentals, keeps the bubble alive. As the last week of October 1929 begins, quiet tension fills the air. Bankers whisper that prices have risen too fast. Economists warn a correction is overdue, but the public ignores every warning. The crowd is too euphoric, too convinced this time is different. That belief leads directly to the night before the crash, the night when the final 12 hours of calm disguise the coming storm. It's Wednesday, October 23, 1929. Wall Street closes with unusual volatility. Prices fall sharply in the afternoon, then they partially recover. Rumors swirl that major investors are quietly exiting. But instead of panic, something strange happens. People convince themselves a rebound will come in the morning. Newspapers call the dip a healthy correction. Radio hosts insist the danger is exaggerated. Banks reassure depositors their money is safe. A false sense of security spreads everywhere. And now, the final 12 hours begin. It's 7 p.m. New York City glows under the streetlights. Restaurants are crowded. Jazz clubs are loud. People laugh, drink, and celebrate. Everyone dreams of the profits they expect tomorrow. But millions of dollars are already evaporating from the market. In private boardrooms, wealthy insiders meet quietly. Bankers, industrialists, and fund managers gather in secret. They discuss the growing instability. They see what the average trader does not. The market has been artificially propped up for too long. Margin debt is out of control. Banks are dangerously overextended. Confidence is fading fast, but they don't realize the window to stop the collapse is already gone. It's 9:30 p.m., newspapers go to print. Most headlines remain optimistic, because the truth is bad for business. One paper writes, "Market expected to stabilize." Another claims, "Banks ready to support the market." It's 11:20 p.m., brokerage telephones stay busy. Some investors call in panic, asking if they should sell. Most are told the same thing, stay calm. Everything will be fine in the morning. It is not fine. Those words seal their fate. It's now after midnight. October 24th, 1929 is only hours away. A day that will soon be known as Black Thursday. While New York sleeps, something terrifying begins overseas. European markets open and instantly fall. Investors there start dumping American stocks. The news races across the Atlantic. Telegraph operators send urgent warnings to Wall Street. The signals are turning red fast. But in America, no one knows. People sleep peacefully, unaware their world is about to change. At 3 a.m., bankers meet again in a tense room. Some demand a stop to margin lending. Others argue that cutting credit will spark panic. No one reaches a decision. Time keeps slipping away. By 6 a.m., newspapers land on doorsteps. A few headlines hint at trouble. Nothing suggests the coming disaster. At 8 a.m., brokers arrive early. Their phones ring non-stop. Wealthy clients want to sell before the opening bell. But the average American still believes the market will rise today. At 9 a.m., crowds gather outside the exchange. People chat excitedly. No one senses the danger beneath their feet. Then 9:30 a.m. arrives. The opening bell rings. The market collapses instantly. Millions of shares hit the floor. Prices plunge without resistance. Panic spreads faster than brokers can pick up phones. Margin calls explode everywhere. Borrowed money investors lose everything in minutes. Ford crashes. General Electric crashes, US Steel crashes. Everything collapses together. The ticker tape falls behind by 2 hours. No one knows the real prices anymore. Fear takes control of the entire market. By noon, over 12 million shares have traded. Every record is broken. Billions of dollars vanish in one morning. The promised bank support never appears. Last night's optimism evaporates. The belief that the market can only go up dies instantly, and the Great Depression begins. But the real lesson isn't the crash. It's why those final 12 hours matter now. The biggest danger in 1929 wasn't the fall. It was the mindset. People ignored slowing economic signs. They believed the boom was permanent. They depended on easy credit. They assumed the market was invincible. They trusted institutions hiding the truth. They convinced themselves this time was different. Today, the same patterns appear again. Record margin debt, massive speculation, stocks far above fundamentals, banks stretched thin, governance promising stability. A new generation that has never seen a real crash. A generation that thinks the market only rises. Those last 12 hours of 1929 are a warning. Every bubble looks strongest before it bursts. Every peak feels safe before it collapses. Every generation repeats old mistakes. Studying those hours isn't about the past. It's about understanding the present. The crash wasn't one event. It was millions of people believing an illusion. The illusion of endless growth. The illusion that risk didn't matter. The illusion that warnings could be ignored. But bubbles always end the same way. Confidence fades, credit tightens, liquidity disappears, and the illusion breaks. As you watch today's financial world, as debt rises, speculation grows, and prices detach from reality, remember those final hours of 1929. History doesn't repeat perfectly, but it always rhymes. If you found this breakdown valuable, subscribe for more deep dives into history, money, and the moments that shape our world. Because the past may not tell us everything, but it always gives us warnings.